I think one of the most important lessons you can learn when you're talking about money management is this: don't lose money. Don't lose money. I know that sounds a no-brainer, but it really is not. Of course, you don't want to lose money, but most investments, particularly the ones that are in brokerage accounts where you've got ETFs, stocks, mutual funds, and things like that, absolutely, most of them go up and down. They have market cycles. There's times when it's great years and there's times when it's not great years. And this happens regularly. Now, if you're working with a financial advisor, they probably tell you, don't worry about it, it's normal. But I don't think that's something you should think is normal. And we've been conditioned to just accept that. Here's what happens when you lose money on an investment. Look, if you had a mutual fund and that mutual fund lost 20% one year, you need to make 25% just to get back to where you were before you lost that money. Let's just imagine you have this really odd year where you go down 20% and then you are lucky enough to get 25% the following year. That's 2 years of no growth. That's 2 years of no compounding. And if you watched any of my other videos, you know how that affects you on the personal level. You actually lose overall because inflation and taxation are going to make sure that you have come out with less purchasing power overall. I don't want to go into that right now. Just understand that when you lose, you have to make even more of a percentage just to get back to where you were. How does it work on higher numbers, you ask? I'm glad you asked that question. If you lost 50% in an investment in 1 year, and some stocks can do this. In fact, all stocks, all mutual funds, this is possible. If you lost 50% 1 year, you need to make 100% after that just to get back to where you were before that loss. Now that could take years, if it happens at all. Point is, loss recovery is a real issue. What if you lose 60%? You got to recover with 150% gain to get back to where you were. If you lost 70% in 1 year, you need 233% return after that just to get back to where you were. That's a lot of risk. So I guess the moral of this is the fastest way to get to a bigger number from what you've got is just to not lose money. Just don't go in the negatives. Now, I know it's easier said than done, and everybody who tells you about investing is going to say it's not possible. I disagree. Here's something not really considered an investment, in that an investment requires some risk. This doesn't really have much risk. But here's what's happening when you compare what happened in the very typical equity market. That's the entire stock market. Some amazing years, no denying. The stock market has done some amazing things over the years. But there's definitely been some down years alongside those. Tons of variety, some spikes up and down when it comes to returns, annual returns in the equity market. And then here's another option that doesn't swing for home runs. It doesn't get the grand slam, but it constantly chips away hitting singles every year. Never a negative number, never negative. And the results are pretty comparable if you look at the big picture. In this case, I'll call it non-investment because it doesn't take on risk. This one, the less risky / no risk side, brings in a return that when combined over the years has actually outperformed the equity market, which has been on a tear, but no variety, no ups and downs. If given the option between something that's going to go erratic, freak you out, and cause you to feel worried about market timing, like if you needed to sell because you got to pay for some big expense coming up and you need to sell right now, you could be on one of those bad years. You could be on a down year, and then honestly, you're probably screwed. You lose a lot of your growth of your asset value due to market timing. Just bad, poor timing that you can't predict. That's just bad luck. On the other side here, when you look at what you could have done, it's a pretty smooth ride all the way up, and it continues to generate positive returns. End result is you don't lose money. If you could have one of these options, it's the one where you don't lose money. So you're not worried about timing and you're not worried about market forces. There you go.